All right, welcome to this explainer. I am absolutely thrilled you're here today because, well, we have a fascinating financial detective story to unpack. Today, we're putting Brinker International under the microscope. You probably know them better by their stock ticker EAT, or simply as the parent company behind that casual dining giant, Chili's. Over the last few months, this stock has been serving up some seriously spicy numbers, and we're going to tear right through the financial data to figure out exactly what is going on behind the scenes. 267%. Yeah, you heard that right. That is the explosive yearly return Brinker stock posted in 2024. I mean, in a market where a 10 or 15% return is considered a really great year, Brinker delivered over 200%. This right here, this is our smoking gun. It's the kind of massive, undeniable breakout that instantly demands our attention. So how did a traditional brick-and-mortar restaurant company suddenly start trading like a hyper-growth tech stock? Okay, let's dive into this. To solve this mystery, here's our roadmap for today. First, we'll look at the massive 2024 breakout. Second, driving revenue and profits. Third, margins and company efficiency. Fourth, we'll ask, is the stock overvalued? And finally, we'll wrap up with debt and financial health. We'll logically translate this mountain of data to see if this spicy stock is actually worth its current price.
Okay, kicking things off with part one, the massive 2024 breakout.
Imagine you were holding Brinker stock back in 2021. You had a rough year, right? The stock dropped over 35%. Ouch. And 2022 really wasn't much better, dragging things down another almost 13%. But then the script just completely flipped. 2024 brought that towering 206.37% return. It wasn't just a good year, it was a total momentum shift for the entire business. But as we know, stock prices don't just skyrocket on good vibes alone, do they? They are driven by underlying business fundamentals. Moving right along to Section 2, driving revenue and profits. Let's look at the underlying numbers fueling this explosion. When we look at their 3-year compound annual growth rate, revenue only grew by a very modest 2.45%. They weren't exactly doubling the number of burgers and fajitas they were selling. But look at the net income side. Net income grew by an absolutely massive 65.24% over that exact same 3-year period. What does this tell us? Well, it tells us that profits grew vastly faster than actual sales. They essentially figured out how to squeeze significantly more money out of the sales they were already making. Over the trailing 12 months, Brinker brought in a massive $4.275 billion in total revenue. And this brilliantly illustrates how those growth percentages translate into massive absolute dollar amounts. Because that efficiency we just talked about resulted in almost $335 million in net income and over $244 million in free cash flow. Free cash flow is literally the lifeblood of any business. It's the money left over after paying for operating expenses and capital expenditures, and right now, Brinker is generating it in spades. Which brings us to Section 3, margins and company efficiency. Let's see how they're actually turning those sales into bottom-line profit. So Brinker currently operates with an 18.49% gross profit margin, but the really exciting piece here is that net profit margin of 7.41%. Look, in the notoriously tough, low-margin restaurant industry, keeping over 7 cents of every single dollar that comes through the door as pure bottom-line profit is a serious accomplishment. That net profit margin is up substantially compared to their historical averages. It's absolute proof the company has successfully fattened up its margins. Let's build on that by looking at their management efficiency metrics. Their return on assets, or ROA, sits at a phenomenal 24.15. And look at the context there, that is up over 155% compared to its 3-year average. Basically, management is deploying the company's assets vastly more effectively than they were just a few short years ago. We also see a towering return on equity of 88.25 and a really solid return on invested capital of 16.73%. From an operational standpoint, Brinker is running like an absolute machine right now. Time for the critical part of our detective story, Section 4. Is the stock overvalued? The price-to-earnings, or PE ratio, is our classic valuation yardstick. Currently, EAT trades at a PE ratio of 20.05. Now, that's not cheap, but honestly, it's not outrageous for a stock with this kind of ridiculous momentum. But check out the forward PE ratio. It drops dramatically to 12.15. What this tells us is that the market and analysts expect Brinker's earnings to continue growing significantly in the near future. If those future earnings actually materialize, the stock is currently trading at a relative discount to its future potential. Now, what's really interesting about this slide is despite the stock price rocketing up over 200% recently, their enterprise value metrics tell a really surprising story. Remember, EV measures the total value of the company, including its debt. The current EV to EBITDA ratio of 10.17 is actually lower than both its 3-year and 5-year averages. The same goes for EV to assets, which is down a staggering 95%. Because the underlying business fundamentals improved so incredibly fast, the stock's valuation multiples haven't actually stretched as far as you might assume. However, as financial detectives, we always have to look at the other side of the coin. To do that, let's quickly review the concept of a margin of safety. This is a foundational principle of investing where you try to only buy a stock when its market price is sitting significantly below its true intrinsic fair value. Essentially, it gives you room for error if things don't go perfectly according to plan. So the crucial point is, Brinker's current margin of safety, based on free cash flow, is a deeply negative 130.04%. According to standard discounted cash flow modeling, there is zero margin for error right now. None. In fact, the model suggests the stock is flying dangerously close to the sun. The market is paying a massive, massive premium for the current growth trajectory, and if Brinker stumbles even a little bit, there isn't a safety net built into the current share price. Let's move to our final section, Part 5, Debt and Financial Health. What's the foundation holding all this up? First up is the debt-to-equity ratio, currently sitting at 1.26. Now, by itself, 1.26 isn't necessarily a panic-inducing number for a mature restaurant chain, but the context is alarming. That represents a massive 1,043% spike compared to its 3-year average. Brinker has taken on a significant amount of leverage recently relative to their historical norms, presumably to fuel this high-flying machinery. And when we look at their short-term liquidity, we find yet another layer of risk in our investigation. Both the current ratio at 0.36 and the quick ratio at 0.31 are quite low. This means that right now their current liabilities heavily outweigh their highly liquid short-term assets. Furthermore, these ratios have dropped over 30% compared to their 3-year averages. They are operating with a very, very tight cushion when it comes to short-term cash obligations. So as we bring all the evidence together in our financial detective story, we arrive at the ultimate question. Is the current stock price right? Or is it just a little too spicy to handle? The contrast here is stark. Based on discount and cash flow models, the calculated fair value price for the stock sits way down at $64.40. Yet, the current market price is towering at $148.14. Investors are currently paying a massive, massive premium over what traditional models say the underlying cash flows are actually worth today. Look, Brinker International has pulled off an undeniable operational masterclass. They skyrocketed their net income, supercharged the return on assets, and delivered absolute life-changing returns for shareholders in 2024. But with short-term liquidity tightening, debt ratios spiking, and the market demanding a steep premium over its intrinsic value, you really have to ask yourself, will Brinker keep sizzling, or is a valuation cooldown inevitable? It's a fascinating dynamic between amazing business efficiency and stretched market expectations. I hope this explainer helped you see the data clearly. Keep researching, stay curious, and I'll catch you next time.